What if I told you that by the end of this video, you'll have a complete roadmap to start investing in 2026, even if you have zero experience? No, this isn't another get-rich-quick scheme. This is your practical, no-nonsense guide to building real wealth. Step by step, we're going to demystify stocks, ETFs, and index funds so you can stop feeling intimidated and start feeling empowered. Stick around, because the strategies we're about to cover could be the foundation of your financial freedom. Hey everyone, today we're tackling a big one: how to start investing in 2026. The world of investing can seem like a complex maze, especially for beginners. But here's the secret: it doesn't have to be. The most important step is simply getting started. Procrastination is the biggest enemy of wealth building. The power of compound interest, where your earnings start generating their own earnings, is a force you want on your side as early as possible. So let's jump right in. First things first, before you invest a single dollar, you need to understand your financial situation and your goals. Ask yourself, why am I investing? Is it for retirement in 30 years? A down payment on a house in 5 years? Or maybe just to grow your money more effectively than a savings account? Your timeline or time horizon is crucial because it determines your risk tolerance. Generally, the longer your time horizon, the more risk you can comfortably take on because you have more time to recover from any market downturns. Short-term goals, on the other hand, call for safer, less volatile investments. Be honest with yourself about this. Don't chase high returns for a goal that's just around the corner. Now let's talk about the big three investment types for beginners: stocks, ETFs, and index funds. Let's start with stocks. When you buy a stock, you're buying a small piece of ownership in a single company, like Apple or Amazon. If the company does well, the value of your stock can go up, and you make money. If it does poorly, it can go down, and you can lose money. The appeal of stocks is the potential for high growth. Picking the right company at the right time can lead massive returns. However, it's also the riskiest of the three. A single company can face unexpected challenges, and its stock price can be very volatile. For a beginner, putting all your money into one or two stocks is like putting all your eggs in one basket. It's a high-risk strategy that I generally don't recommend for newcomers. This brings us to our second option, which is a fantastic solution to the single stock risk problem: exchange-traded funds, or ETFs. Think of an ETF as a basket that holds many different investments, like a collection of stocks, bonds, or commodities. When you buy a share of an ETF, you're instantly diversifying. You own a tiny piece of all the companies inside that basket. For example, you could buy an ETF that tracks the technology sector. Instead of just owning Apple, you'd own a piece of Apple, Microsoft, Google, and many other tech companies all at once. If one of those companies has a bad quarter, the performance of the others can help balance it out. ETFs trade on stock exchanges just like individual stocks, meaning you can buy and sell them throughout the day. They offer a great combination of diversification and flexibility. Our third option, and often the most recommended for beginners, is the index fund. An index fund is a specific type of mutual fund, or ETF, that's designed to track a particular market index. What's a market index? It's a hypothetical portfolio of investments that represents a segment of the financial market. The most famous one is the S&P 500, which represents the 500 largest publicly traded companies in the U.S. When you buy an S&P 500 index fund, you're essentially buying a small piece of all 500 of those companies. You are betting on the overall growth of the entire U.S. economy rather than the success of a single company. This is what we call passive investing. You're not trying to beat the market. You're trying to be the market. Historically, this has been an incredibly effective and reliable strategy for long-term growth. Because these funds are passively managed, they typically have very low fees, which is a huge advantage. Over time, high fees can eat away at your returns significantly. So for a beginner in 2026, an S&P 500 index fund is one of the simplest, most effective, and lowest cost ways to get started. So which one is right for you? Let's break it down into a simple strategy. For most beginners, I recommend a core satellite approach. The core of your portfolio, say 80 to 90% of your investment, should be in a low-cost, broadly diversified index fund or ETF, like one that tracks the S&P 500 or a total stock market index. This is your solid, reliable foundation for long-term growth. It's your set-it-and-forget-it component. Then, with the remaining 10 to 20%, your satellite portion, you can have a little more fun and explore. This is where you might invest in specific sector ETFs that you believe in, like clean energy or artificial intelligence, or if you've done your research and are passionate about a particular company, you could buy a few individual stocks. This approach gives you the best of both worlds: the stability and proven performance of passive indexing, plus the opportunity to learn and potentially generate higher returns with more targeted investments, all while keeping your overall risk managed. Now, how do you actually buy these things? You'll need to open a brokerage account. Think of a brokerage as a store where you can buy and sell investments. There are many great user-friendly options available today, like Fidelity, Vanguard, Charles Schwab, or even app-based platforms like Robinhood or M1 Finance. When choosing a broker, look for low or no commission fees, a good selection of no-fee ETFs and index funds, and an easy-to-use interface. Opening an account is usually a quick online process that takes just a few minutes. Once your account is open and you've linked your bank, it's time to set up your investment plan. And here's the most powerful strategy for beginners: dollar cost averaging. Don't try to time the market. Trying to buy at the absolute bottom and sell at the absolute top is nearly impossible, even for professionals. Instead, commit to investing a fixed amount of money at regular intervals, say $100 every month. When the market is down, your fixed amount buys more shares. When the market is up, it buys fewer. Over time, this averages out your purchase price and reduces the risk of investing a large lump sum at a market peak. The key is consistency. Automate your investments. Set up an automatic transfer from your bank to your brokerage account every single payday. This removes emotion from the equation and builds an incredible investing habit. Let's put it all together. Here is your 2026 Beginner's Investing Action Plan. Step 1. Define your financial goals and time horizon. Step 2. Open a low-cost brokerage account. Step 3. Decide on your core satellite allocation. I suggest starting with 90% in a low-cost S&P 500 index fund or ETF. Step 4. Set up an automatic recurring investment using dollar cost averaging. Even if it's just $25 or $50 a month, start now. Step 5. Stay the course. Don't panic when the market drops. Don't get greedy when it soars. Trust your long-term plan. Investing is a marathon, not a sprint. Your future self will thank you for the discipline you showed today. Remember, the information in this video is for educational purposes only and is not financial advice. It's always a good idea to do your own research or consult with a financial professional to tailor a plan to your specific circumstances, but hopefully this gives you the confidence and the clear, actionable steps you need to begin your investing journey in 2026. You've got this. Thank you so much for watching. If you found this video helpful, please do me a huge favor and hit that like button. It really helps the channel reach more people just like you. And if you have any questions or want to share your own investing plans for 2026, drop a comment down below. I love hearing from you, and I read every single one. Finally, if you want more simple, straight-to-the-point finance content, make sure you subscribe and hit that notification bell so you don't miss our next video. Thanks again. and I'll see you in the next one.